guys that are making millions being paid to prognosticate and to tell us what we should do. Nobody asks, what are their credentials? What's their history? How successful have they been at this? Because it doesn't exist.
It doesn't exist.
But people want to be told.
They want to be told, and they want to be fooled. I mean, there's how many? I heard this all the time about this program or that program, and how it's guaranteed to make you millions. And
lived through them all.
I lived through them all.
20 years,
it's done this. And then it's like we don't want to look at the truth. Is that it's the volatility in the marketplace just kills you. And then when you retire, and let's say you have $1 million, well, you start taking money out, and all of a sudden, you're having to retire on an income stream, and you're screwed, because when those markets hit, you still got to take money out.
Risk aversion and capital preservation.
Yeah,
that's it. That's all you do.
Yeah.
And we have a product that does that.
Yeah.
Okay.
What about let's see. How about bonds? Explain to me. What do you think about bonds? I mean, they balance. They keep talking about you should have 100 minus your age as your percentage of bonds in your portfolio. So if you're 70 years old, 60 years old, say you're between 60 and 70% in bonds, right?
Why would I want to own bonds?
I don't know. I'm asking you.
Interest rates. They're interest rate sensitive.
Okay. So what does that mean?
That means when interest rates go up, and they're pretty low right now, okay, a value of your bond is going to go down. Okay, why would you want that? You paid $1,000, it's now worth $800, and
so are you telling me that bonds have risk?
Absolute risk, big risk.
Oh, okay.
They're as volatile as the market.
I'm just teasing.
Oh, I know. I'm doing this to.
Yeah, but because I think people don't understand that they have bonds, and but they don't understand that even short-term interest, or even short-term bonds, have risk. And right now we're at a inverted yield curve where short-term interest rates are higher than long-term interest rates.
The only bonds that don't have risk are bonds that you hang on until maturity.
But even they have risk.
Well, you don't know what you're looking at 30 years out.
Right. And then the other part is, did you buy the quiet company, or what do they say? Leah Fenton speaks. Yeah, everybody listens. Yeah, and I think that people get so wrapped up now in the stock market. It's such a fad to be involved in it. What's your thinking on the stock market?
The stock market is not a magic sauce that people are enamored. I don't believe most people understand it. I really don't care how bright you think you are. I mean, there's brighter people out there. The people, and I worked in New York for a while, the people in New York that are creating the product have a goal, have a vision, and they're incented. And the people that buy into the market are looking for something that really doesn't exist.
Buy them at a premium, or did you buy them at a discount?
Exactly.
So you don't know, and nobody ever understands that when you look at your portfolio, oh, by the way, you just lost money. But see, that's what happens. People get really burned.
Professionally managed. E.F. Hutton. Professionally managed.
There is no such thing.
That's right. There's no guarantee.
There's no guarantee attached to it.
So anyway,
so let's talk about guarantees. So let's talk about things that we like to talk about, especially when you're talking about, I think there's a thing about liquidity. People get concerned about, but they can say, but if you're getting cash, you've got liquidity, right? So because you don't have liquidity in the stock market like most people think they do, you do not have liquidity in the bond market like you thought you did, because if interest rates rise at all, your value of your bonds go down, and you can't get out of them because you're going to take them out at a loss. If the stock market hits you, then you can't get out without taking a hit.
There are people.
Really, the effect of passive income, or create assets that create income, not just growth. And why is that important in a portfolio, especially when you're trying to have retirement?
I think another adverb there, or adjective, would be non-correlated. Okay, so a non-correlated asset that's growing passive income. Yeah.
So what are the kind of things out there that you see that fit that criteria?
Not many.
Not many, unfortunately.
Hi, I'm Bill Meyer, and I am manager of Northwest Life Funds, one of the very few investments that meet the criteria we have been discussing. no market volatility or little market volatility, and no interest rate volatility. The Northwest Life Funds is an investment in life settlements, and basically they're policies that people have no longer wanted, and I have 20 of them in the fund. That 20 has an average life expectancy of 4 years. Now, 4 years means is that half the policies, meaning 10 policies, would mature within the first 4 years, and 10 would be substantive years. So that would mean that we have roughly about $2 million of cash flow coming off of the policies in every year for 8 or 10 years. That's a lot of cash flow, and it is not subject to the vagaries of the market. If we end up in an economic crisis and the stock market collapses, the fund still kicks out cash flow. It's not determined on the economy. It is determined based on mortality. Now, life settlements have been around a long time, and big investors such as Warren Buffett, Berkshire Hathaway, Deutsche Bank have all invested billions of dollars in life settlements. Now, you as the accredited investor, a smaller investor, can take advantage of these through the Northwest Life Funds. So if you have some interest about learning more about life settlements, please click on the button, and we're looking forward to hear from you. Thank you. That would be...
Where may I find your restroom, Bill?
Well, at least we did it. Oh, go down the hallway to the left.
Thank you.